Many households feel like most of their income is already gone before they make any discretionary choices. In this video, we'll explain why fixed expenses now consume a much larger share of household income, what changed structurally, and why this shift feels so constraining. When people think about budgeting, they often imagine adjusting spending month to month. But for many households, that flexibility has largely disappeared. Rent, insurance, utilities, healthcare, transportation, and debt payments arrive on schedule, regardless of income fluctuations. What remains after those expenses often feels small, even for households that consider themselves financially stable. The key mechanism behind this shift is the expansion of non-optional, fixed costs. Over time, more essential expenses have moved from variable to fixed formats. Housing payments are higher and harder to adjust. Insurance premiums are set in advance. Utilities include growing fixed fees. Transportation costs arrive monthly through financing and insurance. As these fixed obligations grow, they claim income before households can make choices. Even small increases across several categories compound into a significant loss of flexibility. This isn't about spending habits. It's about how essential costs are structured. Households bear the impact through reduced discretionary income and tighter cash flow. Service providers and lenders benefit from predictable, reliable payments that reduce uncertainty. Employers sometimes offset costs through benefits, but rising prices still flow back to households. The system favors stability and predictability, even if that comes at the expense of household flexibility. Once expenses become fixed, they rarely become flexible again. Contracts, financing terms, insurance policies, and infrastructure pricing all resist downward adjustment. Even when usage falls or conditions improve, baseline charges remain. Over time, households adjust behavior around these fixed costs rather than expecting them to reverse. What starts as a temporary increase becomes the new normal. For households, this means budgeting now focuses more on managing what remains than controlling the largest expenses. Small discretionary cuts often feel ineffective because the biggest costs are locked in. Financial stress increases not because people are careless, but because flexibility has narrowed. Understanding this helps explain why money feels tighter, even during years without major financial shocks. Fixed expenses shape household finances by claiming income first and leaving little room to adjust. This channel explains those systems calmly and clearly, so everyday financial pressure makes sense, even when it feels unavoidable.